Hello, and welcome to UBP's monthly asset allocation podcast. I'm Norman Villamin, UBP's Chief Investment Officer for Wealth Management and Head of Asset Allocation. Today, I'll be sharing our views following the dramatic rally in risk assets around the world in April. While we at UBP were able to anticipate the bounce in equities by removing portfolio hedges and adding to our stock positions in late March, investors should not be misled into thinking that the central bank actions to ensure liquidity are necessarily the same as ensuring long-term solvency of companies and households affected by the coronavirus outbreak. As a result, while the path and shape of the new normal in a post-COVID world is unclear, to a large extent, at UBP, we're taking cues by trying to better understand what markets are anticipating, how quickly we arrive at the destination, and using our best judgment, assessing whether those market assumptions are reasonable. This is a similar approach that we took entering 2020. Recall, with the Federal Reserve providing increasing amounts of liquidity, just as it is now, the fundamental dynamics of valuation, earnings, and economic growth were diverging in January, meaning the message the markets were sending was a need to shift focus towards risk management rather than chasing returns. We think that message once again resonates today. As a result, following the 25% rally in global equities from their March lows, we have used the recent weeks to once again reposition portfolios with risk in mind. Having removed much of our asymmetric options overlays in March, the rally in April has encouraged us to reinstate this protection, as global equity markets are overly optimistic about both the timing and magnitude of economic and earnings recovery in our view. As a result, like in early February, our risk-off portfolio has once again taken center stage, leaning heavily on a select group of equity long-short hedge funds, asymmetric structured equity exposure, as well as options overlay strategies, the combination of which helped us weather the February and March sell-downs comparatively well. We continue to look to gold as an important store of value in portfolios in this environment, with governments around the world having clearly outlined their strategy to combat the shocks buffeting the global economy, namely money printing to fund expanding fiscal deficits. The medium-term tailwind for gold has strengthened in the past month. Admittedly, with long positioning nearing historical highs, the prospect of short-term volatility, just as seen in March, exists. As a result, we have paired our core physical gold exposure with options exposure in gold to help manage this risk. In this iteration of our risk-off portfolio, however, we are not relying on longer duration government bonds. While US and German bond yields may indeed fall, we believe at this point the prospect of meaningful yield declines is limited, meaning the risk-reward for investors in these positions is no longer asymmetric in their favor, as was the case in February. With our bond portfolios, without the anchor of risk-free government bonds, we're increasingly looking for opportunities to align ourselves with global central banks and look to their investment-grade credit purchases in euro and US dollar to provide some stability and extra carry for portfolios. Given growth and balance sheet stress as a result of the COVID-19 shock, active, bottom-up bond picking is preferred to passive or index-oriented approaches that have worked so well over the past decade. Selectivity is even more important in the emerging market debt universe, as they lack the overt central bank backstops being offered by the Federal Reserve and European Central Bank. Within global equities, we have expanded our growth and quality bias even further, in light of the uncertain outlook for corporate earnings looking as far forward as 2021. For many investors, this means the comfort and ease of index or passive investing in different geographic regions or global sectors should give way to a bottom-up stock-picking approach, as winners and losers in the post-COVID world will increasingly come within sectors as leaders consolidate market share during this difficult environment. As economies in Europe and the United States begin to reopen following lockdown, and as long as the path and shape of the new normal in a post-COVID world is unclear, we continue to take cues from markets to calibrate our risk management exposure across UBP portfolios. Within portfolios, investors should similarly seek clarity and protection, either by aligning themselves with US and European central banks for shelter and credit, or by focusing on reliability in revenue, balance sheets, and earnings at the company level in selecting equities. If you'd like more information on any of these strategies or ideas shared today, please contact your private banker or visit us on ubp.com. Thank you for listening.